Module 3, Chapter 17, Financial Management. As you read the chapter, please note the following objectives. It's very important that we go through these objectives because they will be important for you to learn them and in order to be successful in this chapter. Financial management, the role of a financial manager, describe the financial planning process, outline how organizations manage their assets, and discuss the sources of funds and capital structure. We're going to identify some short-term financing options as well as discuss sources of long-term financing. And finally, we'll finish our brief conversation on mergers, acquisitions, buyouts, and divestitures. We are not going to make you a financial manager, and we're not going to make you know all of this in one session, but it does give you an appreciation of the role and how it fits into business as a whole. The business function of finance is to plan. It's also to help and be a very, very key player in managing the company's funds to accomplish the overall wealth wealth of the organization, meet their expenses, and also invest in assets. But also, finally, most importantly, is to provide an increase of profits to the shareholders of the organization. Here's a very brief copy of the organizational chart as it relates to the finance position. This is a good picture of what the CFO would be responsible for in the individual departments. But depending on the organization, it could very well be more than that or less, depending on how small and how streamlined the organizational chart is. But nevertheless, it does give you an idea of what the financial manager's role. And we say finance manager because the finance manager could be a CFO. It could be a comptroller. It really does depend on the organization. How small they are really depends on a number of things. So this is just a good overview. Not necessarily 100% of organizations follow this plan, but in general, the finance manager is going to be implementing the financial plan. It's going to be determining its source and giving their professional opinion on the source of funds, which is most appropriate for the organization. And generally, CFOs, if there's named one, will be reporting to the board of directors or the board, any body of individuals who work work with strategic planning for the organization as a whole. Financial manager is always going to be dealing with risk and return. What we do, how we do it is going to depend on how much are we going to get for the risk that we're taking. And again, we're going to have to find that balance. And there's no clear-cut way to find that balance, but it's always a moving target, particularly as the economy changes and things shift around. The goal is always to find that one place, that place where they can say that they are right where they need to be, where their risk is definitely something that is worth the benefit because we're getting so much from whatever we're trying to do. But financial planning is going to be monitoring the flows and inflows of funds. Again, inflows and outflows of funds is a very important part. But by answering these questions, an organization can move forward in their financial planning process. And what are they going to need during the period? What are they going to need additional money? And if they do, how are they going to retain that money? So their plans are going to be definitely based on forecasts and expected sales for a given period. So again, it's going to be using numbers and managing those numbers to give us what we believe is the best alternative. And how we manage assets is going to be how we're going to what do we have and what do we use, and then determining how best to deal with those items. This is just a list of short-term assets and a small example and most common example of the short-term assets an organization generally will have. Obviously, cash is going to be the currency, but marketable securities would be like a money market account, short-term treasury notes, that type of thing. But accounts receivable is going to become your customers directly, and inventory is going to be that product or that item that you sell for return. And again, these are very, very short-term liquid assets that our organization will be using to meet their expenses. Capital investment analysis really is a process where they evaluate their long-lived assets. These assets have an operational benefit. They produce some benefits that last longer than a year. And they're typically substantial in terms of dollar amount, and they are a large part of the company's assets, investment assets. Capital investments is going to be more about how do we, whether or not we need more buildings, whether or not we need to expand our plants to different locations across the globe. When do we replace our assets that we use to provide our economic benefit? So managing international assets is going to be a big deal now because now many organizations are working worldwide, and organizations that are across the country sometimes have to have business employees and facilities within those nations. And it's a very important part of maintaining those assets. So given the fact that we're so global, and this is a very, 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 very important part of our mission here, is to know that globalization is affecting almost every organization across the globe. I mean, everybody is working and paying and investing and supporting and doing business with other people that they would never will ever be able to see face to face. The globalization of our nation is just so impactful. So we need to understand how to manage those international assets, and it's going to be extremely important that we do so. But more than that, how do we deal with the sources of funds and the capital structure? The structure of an organization can consist of either debt capital or equity capital, or both. Debt capital obviously is when you obtain it through borrowing, and it could be borrowing money on a short-term basis through a line of credit, or a long-term basis through mortgages and notes, and and also bonds. But equity could be in a form of ownership, and that could be partnership stake or shareholder in a form of stocks, preferred and common stock. But in the end of the day, most important part of this process is finding that place. This chart here, this gives you that equilibrium, if you will, of the balance between the debt and the earnings. And again, it's more complicated than this, but it's important to note that we want to find the rate of return if we borrow money. What would be our return if we borrow money? What if our rate of return if we were to use it for equity purposes? And that relationship between the two is quite important. And the finance manager is always going to be looking at that relationship to make certain that the decisions that they are making regarding the use of funds and determine the type of funds we're going to use for investment is giving us that proper balance. And that proper balance is most certainly relative depending on the goals of the organization. But more than anything, mixing short and long-term funding is a very important part, and this chart just gives you that relationship between the two. And again, current liabilities, obviously they're less expensive, but their rates of interest are a little bit more volatile. But long-term, you have a little bit more stability in terms of their rates of interest, and they have a use that extends longer than a year. So long-term funding, you have to be very sure about those, but they're far more stable than the short-term funding. But it's also important to note that having both is most important for an organization, for stability, for some sort of leverage within the organization. Now, dividend policy is something that the organization has to consider too, because financial managers have to determine and recommend to the board whether or not they're in a position to provide a dividend and how often it should be paid. So when we talk about dividend policy, that is something that an organization or individuals who buy stocks think about. They think about whether or not their assets going to appreciate. Clearly, they want their stocks to be worth more than what they paid. But also the dividend policy is quite essential as well, because that is also the inflow and the return for their investment, which is important in dealing with organizations who you are trying to invest in. So investments have to be giving you a sufficient return, and the dividend policy is going to be a guiding factor in whether or not that's going to be something that the organizations or individuals who are willing to invest in you are willing to take that risk. Now, short-term funding options include the following, but also note that trade credit is going to be the biggest. Why? Because it's going to be between yourself and your vendors and how you pay your bills back to them. And this is used mainly for cash flow management. Now, when we talk about financing and the source and uses of funds, it's important to maintain sufficient cash flow. And when you're talking about funding options, maintaining positive cash flow and keeping your financing and your funding consistent and stable, trade credit is a good way to do that. But organizations, depending on the type of work that they're doing, will use short-term loans, including installment loans, including different types of credit cards and those type of things, just to make certain that certain bills are paid on a timely basis and the operations can flow seamlessly. But they can also go as far as to have commercial paper. But again, these are all short-term options and available to the finance officer for use to determine their need and how to meet their expenses. Long-term finance is a very, very important aspect of financing, and it entails more than just knowing if we need to have bonds, but how long the bond should be and the interest rate, so forth. But public sale of stocks and bonds is a big deal. Private placements are a big deal, and it's mainly for companies that are private and that are not on the open market. Venture capitalists is another area. A lot of small companies use venture capitalists simply because it's a far easier way to receive financing without having to pay back in terms of a loan. And again, loans are a very important consideration, and organizations do make certain that a loan is the best option for them. But equity funding is also important, and hedge funds is important. But the most important part about long-term finances is knowing what's best for the organization, knowing what is consistent with their mission and consistent with the organization's managers and leaders, i.e. the board, what they're looking to see, and that look in the plan that they have in place, and that this plan of financing is consistent with that. Mergers, acquisitions, and buyouts are finally a big deal because their transaction itself can mass an organization billions of dollars, depending on the type of organization being merged or acquired. But being more than that, it is one of the few ways organizations become so huge over time versus just being popular and increasing in revenues. Organizations that merge with other organizations that are strong become even more stronger or powerful organizations. So this is a very big part of financing and increasing wealth to the shareholders, but it also does make an organization bigger, and in some cases can make them stronger. In this chapter, just understand in general the terms, the role financials play in these processes. Not all of these processes are applicable to all organizations, since some organizations are privately held and some of them are not corporations, which means that ownership stake would not be in the form of a stock purchase. But all in all, we try to cover this information in general terms to get an idea of what organizations will have to think about as financial managers leading them, make decisions on how to manage the flow and the sources of revenues or monies that come into their organization. And as you read through the chapter, just know that this is just a tip of the iceberg when it comes to the role of a financial manager, but I think that their role is extremely important and provides essential information and value to the board and to the individuals looking to them for guidance to how to move the organizations from a financial perspective. As you continue through the chapter, just ask any questions that you may have. And again, I thank you very much for listening, and I'll talk to you soon.